Tyler, it's dividend season. Let's talk high yield stocks.
Oh, one of the rare gems left in the market, companies that actually pay a high yield.
There's a lot more than you think right now. We're going to talk about a few that we like here. Before we get into the details, though, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, check out our special link. You see it on the screen, fool.com/unscripted. Fool.com/unscripted. Go there. You can get access to The Motley Fool's 10 best stocks to buy right now. It's a good time to go check out that list. All right, Tyler, how about you kick us off? What is a high yield stock right now that you think is really interesting?
I'm going to go with Cheniere Energy Partners. Ticker is CQP. Cheniere Energy Partners is a master limited partnership that owns substantially all of the LNG, liquefied natural gas export terminal in Louisiana. It's the subsidiary partnership to Cheniere Energy. And basically, it was this funky corporate structure that they had to use to actually build out this project, because back when they tried to do it in the early 2010s and everyone thought building an LNG export facility was the dumbest idea they'd ever heard, but it actually worked. And as a result, we're left with this dual structure where Cheniere Energy Partners pays a pretty considerable dividend because, well, Cheniere Energy owns a lot of it and they want to get cash out of that business. What you got is you got a business that at Cheniere Energy Partners today, owning that one liquefaction facility, has a dividend yield of about 5.5%. And exporting liquefied natural gas is, at least for this particular business, an extremely stable business. Basically, when they built this facility and they needed the reasonable insurance that it was going to be profitable, they signed customers up to these really, really long contracts where the facility itself took no commodity price risk. And basically they get a fee for processing. So it just kind of makes them like a manufacturing upgrade facility that charges a fixed rate for its services on top of, I think they may be like 15% of the price of natural gas. So there's a little bit of exposure, but it's quite marginal compared to the actual processing fees that they do. These are take or pay contracts, which basically means even if the company that the customer signed that said we're going to take this much away, they have to take it anyways, even if they don't want it.
Use the volume or pay us anyway.
Exactly. And I think it's something like more than 85, maybe more than 90% of all the volumes that leave this facility are under these contracts. So in terms of revenue stability, this is an extremely stable business that is going to probably crank out a reasonable cash flow for a very long time. And that's why that 5.5% looks pretty attractive today. I think from a payout ratio, it's only like 59% of earnings. So it looks like it could grow it if it wanted to. In addition to that, there has been talk for many years of significant expansion at this particular facility. This one is called the Sabine Pass LNG facility. They recently, I believe, brought on what's called Train 6, which is like an additional liquefaction train. So it's going to significantly boost output. And there's been talk about, there's lots of land around it that Cheniere Energy or Cheniere Energy Partners owns to expand this facility even further. And under the current administration that has been a little bit more, I guess you could say, more willing to greenlight LNG export facilities, it certainly looks like that could be back on the menu, if you will, in terms of growth. And so all of these things to me portend to, if you're looking for a reliable dividend payer in the energy space, this is one of those very, very high up on the list. And growth so far has been 5-6%. So you're looking at a pretty good total return rate. There's also been talks of in addition, they're paying down debt. There's also been talk about buying back some shares with sometimes when they have bumper crop seasons, I guess, if you will, when gas prices are really high overseas. And there's some additional upside potential on top of that 5%. Stock price is probably not going to do a heck of a lot, but again, we're buying a high yield vehicle that grows at a reasonable rate. That can be, over the very long term, a very reasonable trade-off.
One thing I just want to add that I think is important to know is the way that it pays its dividend structure. It can make it look lumpy. It can be lumpy, right? But the base dividend is really secure. So again, talk about bumper crop season, right? Back during this period, things like the need for energy in Europe was one of the things that really boosted its results.
Those were special dividends that were paid. That's the key.
I want to share this tab here from the company's distribution history. And you see that's, and it's 77.5 cents a share right now. That's the base dividend that comes out every quarter. On that same day, you see it pays another dividend. It's a special dividend. based on excess cash flow, right? So you see that amount is variable from period to period. So this is just the last few quarters. So wanted to let investors know about that. If you do look at the stock and you look at the chart and you're like, well, it looks like they just cut the dividend. No, the base dividend is very secure. It's that special dividend based on excess cash flows. It's great that they do this because, again, when times are good, you can get that extra payout, but they preserve enough cash to keep the business safe as well. So I think that's really good. So Tyler, you know who just pays a base dividend and has a pretty good track record of just growing it every year?
I'm going to guess you're going to go with a really large company that might just be a little bit in the dumps lately.
That's right. PepsiCo here. You can see the dividend. They basically grow it every year and have a long track record of growing that dividend every year. So PepsiCo, it's funny. The thing about PepsiCo is that a lot of times, Tyler, it's like the backhanded compliment that you're the Pepsi to whatever's Coke, right? It's the thing is that's interesting is that Pepsi has been the bigger, larger, more profitable business than Coca-Cola for a long time because of the snacks business that they've acquired and expanded and grown over years. The Frito-Lay business that they own, that's a big part of their results. And like you said, its stock's beaten down a little bit right now. Some of their business is struggling. That snacks business isn't doing as well. And as a result, the stock prices come down. But what's interesting is as that has happened, I think for me, the best way to think about it without getting too deep, we don't need deep analysis every single time we talk about a stock. It's made the stock buyable again for the first time in quite some period of time. So now we're trading at decade low earnings multiples here. You can buy this business for less than 20 times earnings and you can get a dividend yield that's more than 4%, Tyler. I think if you're looking for yield that's above average and you want to own a grower, PepsiCo should be on investors' lists right now. Is this going to beat the market? I don't think that it necessarily will. Unless we see a relatively below average market over the next 5 or 10 years that's not generating 12, 13% returns like we've seen, it's probably going to perform around the market or a little bit lower. But for investors that are looking for income, a really stable, strong business, so maybe like the kind of yield you can get from a bond with maybe a little bit more risk, but you know they can grow the payout. I think PepsiCo's right in that for a lot of investors. I think it's very compelling. Hey, Tyler, you want to do one more?
You know, it's your channel, Jason. We can do what you want. Go ahead. Do it.
You know we're going to talk about here.
We're going to talk about Brookfield.
Specifically,
Brookfield Renewable.
We are. So Brookfield Renewable, man, it has been a kind of ugly, weird, tough cycle for renewable energy stocks with the Trump administration. But at the same time, businesses like Brookfield Renewable are super important, run by some of the best capital allocators in the world, and not just going to roll over and die with less favorable policies in the US. So I think that's important to begin with there. It's a very diversified business, operates in a couple of dozen countries, and their assets are the big utility scale, commercial, renewable energy production facilities, from as obscure as hydroelectric dams in Latin America to solar panels on top of a parking structure and everything across the wind and solar spectrum in between. Now, the way the business works is it's like the toll booth kind of business in a way where you have these assets that are very long lived. You sign these long-term contracts, like 25-year contracts with the buyer of the energy that these assets produce. You sell them the energy at a cost that is very compelling and helps them meet whatever their carbon reduction goals are and their energy need goals. So like Microsoft with their big AI power needs has been a big customer in recent years. So they make their money by having really good access to cost of capital. So their finance costs are low. So you build these really long-term streams of cash flow, right? So as much as we think about renewable as this like high-tech, innovative stuff, this is a blocking and tackling, pay good prices for good quality assets, sign up customers for long-term contracts, finance them right, price it right, and you just pump out cash for the long term. So on the screen I'm sharing right now, the dividend yields that you can get, and this is just since the beginning of the year. So Brookfield Renewable Partners, ticker BEP, yields above 6% right now. That's extraordinarily good for where it has been over the past 5+ years. Brookfield Renewable Corporation, BEPC, has only existed for about 4 years. The dividend yield's about 5% there. It typically trades for a higher price with a lower yield because it's a corporation. So there's a little more favorable tax treatment for the dividend because it's a qualified dividend versus the partnership. That's the difference between the two. Roughly the tax effective dividend for US investors held in a taxable account would be about the same with either of these that you bought. I like to own them in a retirement account, so I buy Brookfield Renewable Partners. So that's the short version. You can get, this is one of the best valuations I've seen for this business in a very long time. It's extraordinarily strong. There are still wonderful tailwinds for growth. The sun is bright, shining on these businesses. So I continue to like them. And I think for dividend investors looking for high yield and also pretty solid growth, right, Tyler? They grow that payout kind of high single digits pretty much every year.
Every single time we do the Brookfield shtick, I'll just say this, what you're not, the most important thing for me when buying Brookfield is the people, because they're good at underwriting these businesses at a low cost of capital. And as a result, they continue to grow their dividend at 5 to 9%. Like, mail it in, because it's going to happen year over year over year, because it's what they do best. And for all of the analysis of like where the renewable market is going or whatever, you can more or less kind of take faith in the fact that they're really good at allocating capital and buying things for the cheap.